while house prices have fallen by about 30% from their peak in 2005 to where they are today, we probably will see another decline on average of upwards of 10%. And that is because there's still such a huge overhang in terms of the volume of homes available for sale right now, or that will be available for sale over the next year.
The question is how long and how deep will the housing market collapse be? Happy almost Friday, happy Thursday, and welcome back to Real Estate Mindset. Obviously, this video is going to be absolutely bonkers. Now, the data is in, and before I go into the leading indicators, I want you guys to pay attention to what's going to happen in the market today in regards to the reverse repo market, because we are losing liquidity in the market. So on top of the 10 and the 2 inversion, we are finally making progress once again in the liquidity and inflation sector in the economy, better known as a suspension or reverse repo market. It's finally down, you guys, to $286 billion. Do you think we will have an inversion of the 10 in the 2-year treasury this week? Take a look at the charts this week and look at how close we actually are to an inversion. It's ridiculously close. And I also want you to know that Redfin's report isn't even out yet. I've already got the data. I'm not even waiting on the report. If you don't believe me, look at the time that this video is released and then go to Redfin. You guys, we don't even need their report. We could just look at the data ourselves. And the way I'm doing this is I'm putting a 2022 overlay on top of the 2024 data. The reason I'm doing that is by now you should understand that the second half of 2022, we experienced deflation in the housing market. I think it's very important to compare those two things, because I'm also saying that I believe that we're going to have a faster price crash this year in compared to 2022. And so I'm going to go over and tell you exactly what that looks like from a median sales price standpoint. A couple more things before I begin. Always understand that we're going over macro data. If you want to understand what's going on in your local housing market, you must do subdivision analysis generally in a subdivision. That's called comps. Comps are properties that sold. Now, when I'm looking for properties, I want to have properties and find homes that are under 2019 values. On top of that, also understand that the data that we're reviewing is proprietary data. Oftentimes, median sales price is manipulated, as is the data, because they don't use everything. These companies choose what to do in order to support their narrative. So it is what it is. Either way, you guys, let's start with the median sales price of homes on a nationwide average. Now, this is Redfin's 4-week rolling median. So it's important to always quote your data source, since median varies so greatly. First and foremost, I want you guys to understand that we have our 4th week in a row of median sales price decline. So home prices are collapsing. I'm sitting here, I'm telling you that specifically. The only chance the bulls have at their narrative being supported is if seasonality somehow comes back in February of 2025. And please do me a favor, you guys. I want you to comment below and tell me why or why not you think we will either hold or break seasonality in 2025. Now, first of all, the black line once again is 2022. And remember, that black line was above the gold line. It was revised downward greatly. It almost hit 400,000. We got a lot stacked against us if you want to see real-time price decline. Nevertheless, home values peaked around July 7th at $396,000. 4 weeks later, actually guys, a little less than 4 weeks later, we're now at $390,000. That represents a decline, okay, of $6,000. Now, on the left of the graph, I've also listed where we were at as far as the 4-week rolling median, which was $361,000 now. Which means if we're going to have year-over-year price decline, we got to get from $390,000 down to $361,000. Now, remember, you guys, I've also got on the record and said I believe this year we're going to have a nominal, not real. Real's adjusted for inflation. I want to the bone. I want nominal of 5 to 7%. That would mean the data that you're looking at and the median sales price would have to go all the way down to $343,000. Now, it's obviously going to be a lot easier just to get to the baseline year-over-year price decline. It definitely looks like we're going to hit that. But in order to hit the 5%, we're going to need the same trajectory we have right now to continue throughout the year. And I want to know what you guys think. How do you think we're going to end this year on a nationwide as far as median sales price? I want to move on to new listings, and I want you guys to ask yourself this question because we see a spike, okay? Again, we see a spike in new listings. Take a look right here, you guys. So you see the trajectory is spiking. Right now we have added 95,968 new listings to the market, which represents 5.9% year over year. And my question is, okay, is this spike a result of increased defaults, increased forced selling, and or the result of the golden handcuff effect? I mean, think about it, you guys. We've had interest rates drop pretty good, and now look at the new listing data. So rates go down and new listings shoot up. I want you guys to think about that because I've been saying if we have unemployment and recession and rates go down greatly, we will have a lot of home sellers get off of the sidelines and dump inventory into the housing market, making it much worse if you're an owner. Now, if you're on the sideline like I am, it's going to be a great opportunity to buy, which is why this entire time I've been working on my purchasing power, my credit, my income, my assets, and my overall comprehension of my own local housing market. Before I go into my 3 leading indicators, which is active inventory, price cuts, and days on market, I want to quickly play this clip of Obama at the start of his presidency, and I want you guys to listen very carefully, and I want you guys to ask yourself this question: are things better or are things worse?
Families cannot pay their bills or their mortgage. Many workers are watching their life savings disappear. And many Americans are both anxious and uncertain of what the future will hold. Now, I don't believe it's too late to change course, but it will be if we don't take dramatic action as soon as possible. If nothing is done, this recession could linger for years. The unemployment rate could reach double digits. Our economy could fall $1 trillion short of its full capacity, which translates into more than $12,000 in lost income for a family of 4. We could lose a generation of potential and promise as more young Americans are forced to forego dreams of college or the chance to train for the jobs of the future. And our nation could lose the competitive edge that has served as a foundation for our strength and our standing in the world. In short, a bad situation could become dramatically worse.
It's kind of like a joke at this point because everything, correct me if I'm wrong, you guys, it seems much worse. Now, moving on to our first leading indicator, and by leading indicators, these are indicators that I want you guys to look out for in your own local housing market. Again, though, if you want to get hyper local, you got to go to your subdivision and figure out what's going on there. Now, starting with active listings, beautiful thing. I've called this back in December. I thought we would hit 1 million active listings this year, and we certainly did that. Right now, we're sitting at just over 1 million active listings at 1,02,695 active listings. That is a year-over-year increase in inventory of 18.92%. I also want to bring your guys' attention to the left bullet point I wrote right there, which is basically saying we hit 1 million active units at the end of June of this year. And isn't it funny, you guys, that 1 week later was the start of our price declines? You guys remember me saying that the whole time? We needed 1 million active listings for the prices to go down. Now, with the other leading indicators, what I'm also saying is it's going to be an even sharper price decline than 2022. Now, let's move on to our second leading indicator, which is this bad boy right here, price cuts. We have a new all-time record high in price cuts. Now, real quick, guys, before I go over the price cuts, what do you guys think that Redfin is going to name their article? Personally, I think it's going to be something to the effect that mortgage rates have dropped and a slight increase in demand, but I think it's 50-50 for them to add the historical record-breaking price cuts. And do me a favor, don't look at the article name yet. Guess below what you think Redfin is going to name their article. So again, those 3 things is what I think is going to be in the article. I give it 50-50 on this right here. You guys can see, again, all-time record high price cuts surging greatly. So how do you explain that, you guys? If rates are lower, right? How are price cuts surging? It's because demand has not kept up. As you see here in the chart, we're at 7.2%. Never before have we had sellers out there that are trying to sell their houses that are slashing their prices at this pace. It's like sellers right now, you guys, are hitting the panic button saying, please purchase my house because I don't want it anymore. I probably should have never purchased it. And I'm not knocking you if that's you, but I am pointing out that home ownership right now is very dangerous and very expensive. And one of the things we're not even getting into is the fraud that's going on with property taxes and the overwhelming insurance expenses throughout Texas, Florida, in California. Take a look at our last leading indicator, which is days on market. We've been over 30 days on market for a long time. We're sitting at 34 days on market. And this right here, guys, should explain to you that median sales price is manipulated. The reason why prices seem like they haven't dropped even more than they're already dropping right now is because of the higher end of the median has growth, whereas the lower end of the median does not. So when you have high-end growth and you have no low-end growth, it's going to appear that the median is going up, when in reality, the median can really be going down. And when we throw these proprietary things in there and these price buckets, it's really hard to trust median, which is why I keep going back to you to say, do your subdivision analysis. You guys know that I have a form listed in the description to give to you for free. It allows you to calculate both wedge and cash flow, something I've made to give back to the community. And also, don't forget, I very rarely push this, and I should. I've also made a free home buying course. I put 20 years of my experience as a realtor and loan officer and CE instructor, not to mention I probably closed and helped over 1,000 consumers buy a house. You guys, I made a home buying course. Please, whether you agree with me or not, take the home buying course. You will learn something, I can guarantee it. And it won't cost you anything except your time. But as you guys can see here, going back, this is 34 days on market. That is up 5.8 days year over year. Now, it took until October of 2022 for us to hit 34 days. All of the leading indicators that I just went over with you are accelerating ahead of what was going on in 2022. And they revised the data downward in 2022. So why wouldn't we have an even faster home price crash? And then why would people think that demand would flood back into the market in 2025? I mean, seriously, guys, we're on the front end of a recession. Unemployment is going up. We see that in the trajectory of unemployment. All categories of consumer default are accelerating. Consumers right now, you guys, are broke and behind on their bills. And look at the rent data. The rent data is suggesting that over 13% of renters, so it's hard to imagine, are currently behind on the rent. That's a horrible, horrible anxiety to live with. And you may ask the question is like, how did we get to this point? And I'm going to tell you guys, it doesn't matter if there's a Republican or a Democrat elected. The reason why we got to this point is greed, corruption, fraud, and the Federal Reserve. What I want to do is listen to George Bush. And again, as you're listening to this video, I want you to ask yourself this question: are things better or are things worse?
How did we reach this point in our economy? How will the solution I propose work? And what does this mean for your financial future? These are good questions, and they deserve clear answers. First, how did our economy reach this point? Well, most economists agree that the problems we are witnessing today developed over a long period of time. For more than a decade, a massive amount of money flowed into the United States from investors abroad because our country is an attractive and secure place to do business. This large influx of money to U.S. banks and financial institutions, along with low interest rates, made it easier for Americans to get credit. These developments allowed more families to borrow money for cars and homes and college tuition, some for the first time. They allowed more entrepreneurs to get loans to start new businesses and create jobs. Unfortunately, there were also some serious negative consequences, particularly in the housing market. Easy credit, combined with the faulty assumption that home values would continue to rise, led to excesses and bad decisions. Many mortgage lenders approved loans for borrowers without carefully examining their ability to pay. Many borrowers took out loans larger than they could afford, assuming that they could sell or refinance their homes at a higher price later on. Optimism about housing values also led to a boom in home construction. Eventually, the number of new houses exceeded the number of people willing to buy them.
I don't know, guys, things seem way worse to me overall, but in my household, when I look back, my household is actually doing a lot better. I've changed my life. I've understand what's important to me, which is my family and my quality time that I spend with them. It's not this whole rat race. I'm not buying into it anymore. I'm not going to waste my money. I'm not going to spend to the end. I want to go directly at the bullish narrative that we've been hearing for the last 2 years on how as soon as interest rates go down, there's going to be a flood of home buying demand. Now we have enough data to prove otherwise, because obviously, guys, interest rates are going down to the mid to low 6%, and in some cases under 6%. And yet demand has pretty much flatlined. So in other words, the only thing that the lower rates are doing right now is getting sellers off the sidelines. Now, before I show you this data, that doesn't mean that we won't have an uptick in demand. We will have an uptick in demand, but what I am saying is the uptick in inventory is going to exceed the uptick in demand. Now take a look at this, guys. This is Mortgage News Daily Composite Index, which is demand. That's home purchase applications and things like that. So that's the composite index versus 30-year fixed rate mortgages. Now the mortgage interest rates are in orange and the composite is in blue. And now what I want to point out is you see that middle dot right there with the arrow going downward, we have essentially dropped from the peak in May. Okay, we went from 7.22% all the way down to 6.73%. That represents a 49 basis point decline in residential mortgage rates, which again does not track the federal funds rate, although for sure the Fed manipulates mortgage rates. I don't care what anyone says, they 100% manipulate mortgage rates. That is a fact, more than the bank. The bank, they manipulate mortgage interest rates more than the banks. It's called mortgage-backed securities, quantitative tightening, quantitative easing. Ever hear of it? Nevertheless, purchasing power has gone up 4.9% from May to right now. And yet, if you look at that blue bar right there, the composite index has essentially stayed flatlined. So purchasing power increases by 5%. The composite stays flatlined. And then when we look at the year-over-year information on the bottom left, you can see the composite is also down year-over-year, going from 208.4 down to 206.5. So demand is lower year-over-year. At the same time that interest rates are lower as well year-over-year, going from 6.96 down to 6.89%. And you guys, that's this week's housing market update. Again, we don't need to wait for Redfin. We can knock this out ourselves. I hope you appreciate that. I'm kind of excited to see what title are they going to come up with this week. And also, I will also acknowledge, thank you for the data, Redfin. I just don't agree with your analysis, your conclusions, or your mathematical formulas, because I've often proved you wrong. And also, don't forget, they manipulate the trajectory on that 4-week rolling average. I've seen it. I've showed you guys that constantly. I want you guys to remember all of that data that we went over, you can't trust it. Okay, remember again, it's proprietary information. They're constantly changing price buckets. They're constantly being paid to change their narrative, so you gotta go hyper local. And other than that, guys, don't forget, if you wanna join the movement, if you wanna help Mitch Wexler try to end the corruption with the central appraisal districts, don't forget to read and sign the petition in the description. Join the movement, help us end the fraud and corruption. Now, other than that, guys, enjoy your Thursday, almost Friday. Thank you for watching this video. I look forward to hearing from you. And if you guys are out there investing in real estate, you guys already know I wish you luck, and I hope you win.